So today we're going to talk about what I like to call the 5 R's of reviewing a PPM, private placement memorandum, when you're looking as an investor to decide. So we get a lot of, we help people raise capital a lot. And when our clients come to us, they want us to prepare the PPM. But we also get people who are potential investors, LPs, limited partners, who want to come in and invest. And they say, hey, can you review this for us? So I just want to go over some of the things as an investor that you might want to look at when you're looking at investing and you're reviewing a private placement memorandum for a deal. So I'm going to share my screen real quick. All right, reviewing a PPM. So what I like to call the 5 R's of reviewing a PPM, and these are just primary areas to look at. It's not everything, but it's kind of some of the more material items. What are your rights? What are the returns that you're going to potentially get? What are the risks of investing? That's a huge one. Reputation of the people putting the deal together, and the reasonableness of what they're telling you. So I'm going to go over these in a little bit more detail. First, I want to talk about what exactly is a PPM. If you haven't heard of one, it's a private placement memorandum, a offering circular, offering memorandum, prospectus, disclosure document. It goes by a lot of different names. Most people just call it a PPM. And essentially, it is not a legally binding contract. Make sure you understand that. What it does is it discloses to you, basically for securities law purposes, as a potential investor, kind of what the deal is. What am I getting myself into? What are the risks of investing? What am I going to get out of this investment? That's basically the purpose, is to fully inform you before you make an investment decision. So that's the purpose of a PPM. So someone raising money comes to you and you say, okay, well, let me take a look at your PPM and kind of get a better idea of what you're trying to sell me here. So it informs the investors about the terms of the investment and the risks. So what normally goes into a PPM? So most PPMs are done under what's called Regulation D, Rule 506, and Rule 506 typically looks at Rule 502, which talks about what needs to go into a PPM. And this can vary, but essentially there's certain non-financial and financial information that needs to be put in to the extent material to an understanding of the company doing the investing, of the business of the company looking for capital, and the securities being offered. So to the extent material. So that's not necessarily a full list of everything has to be in there. It's just what the SEC is saying. If it's material to understand what's going on here, it should be in there. It's also listed out that it talks about Form 1 or 1A, which is an SEC form you can look up online and see what it talks about in terms of financial and non-financial information listed in Part 2 and Part F/S, financial statements. What are the topics that are usually covered? An executive summary, essentially a little bit about the business and why they're raising the money, risk factors, SEC disclosures. There are certain things that you need to be told based on what Regulation D tells the issuer they have to basically disclose certain things to you. A little bit about the company, the background, the ownership, the structure. Is it an LLC? Is it a corporation? Who's running it? Description of the business plan. So what exactly is the plan? How are they going to use the money that they're raising? A little bit about the industry that they're in, competition that they might face, their sales and marketing plan, operations plan, hiring plan. A lot of PPMs may not get into that much detail, but a full business plan would have some of that information. So if you have it, it should go in there. Financial projections. Again, these are not guarantees of return, but basically, what are we proposing? Like if we use your capital and we put it into this business, what do we think we're going to get out of it in the future? What are the terms of the offering? This means, what exactly am I getting for my money when I give you a check or wire you money? What are the sources and uses of funds? So, okay, we're going to bring in some capital from investors, $3 million. We're also getting a loan for $5 million to purchase a property. What are they going to use the money for, and where is it coming from? Also, what's the exit strategy? What are they planning on doing Are they going to sell this and sell something and hold it for 3 years? Is it going to be cash flowing in 2 years? And then they're eventually going to go public. What exactly is the exit plan to where there's going to be cash enough to pay you back your investment plus any kind of return? So I mentioned the 5 R's of a PPM review. So what are the 5 R's? First, you have rights. So rights are not in a PPM. They might be disclosed and explained in a PPM, but the PPM is not a legally binding contract. Now, if there's a lawsuit by an investor, they could bring up a PPM and say, here's what was disclosed to me in writing. They didn't follow it. That could potentially be something along the lines of securities fraud, where it's a material misrepresentation or an omission, or just, they said something outright false in there. That can be the basis for a lawsuit, but your actual rights are outlined in either an operating agreement if it's an LLC, or a limited partnership agreement if it's a limited partnership. So you want to make sure you read through that. It can be lengthy, and this is about the only part that's really heavily legal, is reviewing that as basically a contract to say, if I give you my money, I become a limited partner, a Class A member. What are my rights? What are my voting rights? How can I get out of this? Can I transfer or sell my ownership? What are the rights that you're saying that I have when I give you a check? There could be a shareholders agreement if it's a corporation that you're giving capital to, or some other type of contract that outlines what your rights are. So you want to make sure you review that and understand it. Now, PPM may explain, it could have a summary of the operating agreement or explain some of your rights, but unless it's in the operating agreement or limited partnership agreement, that's really the main contract that you want to make sure it's in. Then there's the PPM, obviously, that explains, like I had mentioned, about the business, what they're doing, the terms of the offering. Subscription documents, usually this is the agreement that you sign, subscription agreement, that says, yes, I'm giving you $100,000 in exchange for 100 Class A units or 1,000 shares of stock, whatever it is that you're getting. And usually it'll have like representations about securities law representations. You're not buying this on behalf of somebody else. You're making your own informed decision. Some of those things are going to be in that subscription agreement, but that's basically the contract between you as an investor and the company that you're putting money into, saying, I'm agreeing to become an investor. May also have what's called a joinder agreement that says that I'm agreeing to be bound, legally bound by the terms of the operating agreement or limited partnership agreement of the company I'm putting money into. So that joinder agreement means that you're agreeing to all the terms of that underlying operating agreement or limited partnership agreement. So you want to make sure that you've read it and understand it. Second are returns. So you want to make sure you understand, what are the projected returns that I'm supposed to be getting? What are they promising me? Maybe not promising. They shouldn't never say promise, but we plan or expect to use your capital to purchase a property that we're going to fix up and sell in 3 years, and you're going to get a 2 times your money, 2x equity multiple, or 150% return on investment, or 13% IRR. What are the projected returns that their financials show that you're going to get at the end? So you want to make sure you completely understand how they're getting there too. So how is it calculated? So if they're saying, okay, look, in our PowerPoint presentation, it's a really quick slide that says, we're planning to get 7 times your money in 2 years. How did they calculate that? Where is that coming from? You want to make sure you understand the basis of how they're calculating that, because maybe they don't want to show you all of their detailed financial analysis, but you need to understand how they're coming up with those kind of returns. What are the assumptions behind those returns? So if it's a real estate deal, a multifamily property, are they planning on going from 60% occupancy to 98% occupancy? Are they planning a refinance? What are some of the assumptions that are going into their financial model so that you can understand completely where they're coming from? And if they don't want to tell you how they calculated things or what their assumptions are, that's a huge red flag. Risks. This is a huge one. It's shocks me when people come to me and say they just foreclosed on a apartment complex. I invested some money in it. I want to sue the people that I invested the money through and get my money back. Well, it's probably too late. Your money's probably gone if it's been foreclosed on by the bank. And a lot of times you have no recourse. You have to understand that when you give money into a private deal like this, there's no guarantee you will get your money back in most cases. So you have to understand what are all the risks of things that could go wrong. So I completely understand when I write a check for $100,000 and give it over, that if inflation goes up, if interest rates go up, if something happens on the property where there's a lawsuit, what are the different risks involved? Is it a company that's investing in a highly regulated industry where there could be some kind of enforcement and the company gets shut down? What are all the risks involved so you completely understand, so you're not surprised when something potentially goes wrong? And this is going to be in the risk, actually, that's the wrong one. That shouldn't be on there, but this is in the risk factor section of the PPM. And this basically will say, all right, so we have all of these different risk factors of the business, of the manager, of the industry we're in, of the securities we're offering. What are all those different risks? And I understand risk factors usually is half of the PPM. It could be 20 or 30 pages long, but make sure you've gone at least and skimmed through those. The fourth R is reputation. So this is a critical one because just like I mentioned before, you're taking on a lot of risk. There's no guarantee you'll ever get your money back or ever see a dime of the check that you write. So totally understand that ahead of time. What is the reputation of the people putting this deal together? The PPM is going to have a section on management, and it should tell you who the people are who are going to be officers, directors, managers, general partner, whoever's running this deal. There should be information about that person, their bio, like what is their background, what is their experience in this industry, so that you review that and say, okay, they've never done this before. So you understand, hey, this is their first time doing this, or they have this great track record of similar deals. And have they been sued before? Is there pending litigation against them? Some of that stuff may need to be disclosed in the PPM and some of it may not. So you make sure you did a little due diligence on who's trying to sell you into this deal. All right, reasonableness. Now, this is, a lot of these are not necessarily legal issues. They're more investor or business terms. But I say reasonableness. And what I mean by that is how reasonable is it what they're telling you? You'd be shocked that, the people that come to me or I see lawsuits happen and I read through or SEC enforcement and I read through what these investors were told. And I'm just shocked that any investor would actually give money to this person when they're making outrageous claims. Okay, I'm going to give you 7 times your money in 6 months. That's not realistic at all. So how reasonable is it? All of the things that you're being told, whether it's the return you might get, the projections for the business. Okay, we're a startup and we're raising $10 million. We're going to launch our first product and we're going to go public and be a $10 billion market cap company in 1 year. Is that reasonable? No, not at all. So just use your judgment and say, is this really reasonable? Does it sound too good to be true? If so, it probably is. It's very rare where something that sounds too good to be true ever works out. Very rare. I've been practicing law for 23 years, and I've never seen a case where somebody has said they made crazy guarantees and, all this stuff that was going to happen in the company, and it happened. I've never seen it. So, and always make sure part of securities law is to protect you. Before you make an investment decision, they are required, the person selling you a security is required to make sure you understand this investment and all the risks, because they could face regulatory action or lawsuits if they don't. And especially Regulation D even talks about this in Rule 506, that you're supposed to make sure that the investors have had If you have a PPM, they need to see it before making an investment decision, a reasonable period of time prior. Also, they have to have the opportunity to ask questions of you and ask for any additional documentation. So if there's something all you see is a pitch deck and you haven't even read through the PPM, or you skim it over and you say, I don't understand, you have a right to ask questions and ask for backup documents. Hey, this is a apartment complex and these rent numbers look crazy. Can I see the last 12 months of a rent roll or a T12 or something to show me like what exactly is happening with this property? And if somebody says, if someone who's trying to get you to invest says, you don't need to see that now, I mean, you just need to trust me, run. That's a huge red flag. I mean, be realistic. Don't just trust someone because of who they are, what they say. Huge frauds have been committed by people that, everyone thought that they could trust. They had a good reputation. So how reasonable is it what they're promising you? So make sure you go through all of these when you're reviewing a potential investment and the PPM. So just a quick recap on some of the things to watch out for. Is it in writing what you're being told? So if the pitch deck says, we are going to return your capital within 2 years guaranteed, is that actually in writing somewhere? A pitch deck is not a binding agreement. So is it in an operating agreement, partnership agreement, some kind of investors' rights agreement? Is it a legal contract that tells you, yes, here is exactly your return you're going to get? Because you want to make sure it's in there in a legally binding document and that you understand all of the risks and the investment itself. The risk factors, I mentioned those, understanding all the potential things that could go wrong, and understand that you can lose all your money and have no recourse. I can't stress that enough. So many people come in and say, I just want to sue. I mean, that's not fair. That doesn't mean you have a legal right to sue them. And even if you can sue them, what if all the assets are gone? They're structured so that the people putting these deals together are usually pretty protected. They don't have any personal responsibility. So if the LLC that you put money into has been foreclosed upon all of their assets or filed bankruptcy, you might be able to file a claim in bankruptcy, but if there's no assets to distribute, you're out of luck. You're at the bottom of the totem pole as an investor. Side letters, the SEC recently put in some new private fund side letter regulations within 2023, at the end of 2023. So there are some more restrictions on what can and can't be done. And a side letter is essentially an agreement between the people running the deal and some usually larger investor. Hey, I'm going to give you better terms than I'm giving everybody else. So you want to make sure you understand, do they have the right to do this without a vote? Do you have what's called most favored nations? Meaning, if you give better terms to somebody else, I have to get the same thing. You can't just give one person better terms. The SEC rule is probably going to clamp down a little bit on this, but make sure you understand, does it give them the right to do side letters? And what do you have the right to vote on? Or what can they do without your vote? One of the most common is anything that amends or changes the operating agreement or partnership agreement. Usually you want to make sure there's something in there that there's a vote and that it doesn't negatively affect either your class of ownership or your individual returns of what you've been promised. Because if they can amend it without your consent or vote, they could potentially take rights away from you without you having any say-so. And just like I mentioned, reputation, what's the sponsor's track record and history? Anytime somebody says guarantee, that's always concerning. If we guarantee you're going to get double your money in 6 months, we're making all these claims that this company is going to go from a startup worth nothing to worth $10 billion in a year. If it sounds too good to be true, it probably is. Again, if you see any difference between what you're being told in person or a webinar or a pitch deck you're provided, and when you review the PPM, all the documents you're going to sign, and you say, wait, you said we were going to get this certain right, and it's nowhere in the documents I'm signing, that's a concern. Because a pitch deck is not a legally binding agreement. PPM isn't even a legally binding agreement. You can sue based on it for potential fraud, but what is the contract I'm signing? Does it have all the rights and things that I was promised in there? Because you want to make sure that stuff is in there. So any claims that are being made that cannot be backed up with any kind of documents or actual sources, that's also a concern to watch out for, or any one running a deal who says, oh, just trust me, or you don't need to see all that stuff. That's definitely a concern. So that's just a quick overview of kind of what I call the 5 R's of reviewing a PPM. So make sure that you take a look at this, go through all 5 when you're reviewing a PPM, and good luck in your investing. Thanks for watching.